All right, so my name is Chris Fasano, and today I'm speaking with John Chartrand, Chief Investment Officer at Capcom Financial Services. I'm excited to have John on to answer some of these questions because, there's a lot of things going on in the world right now. We're going to use the word unprecedented probably a lot today, but a lot of things are unprecedented, and including in the world of this pandemic in the financial realm, a lot of questions are being asked. So John is going to answer some of those most burning questions that he's been asked. And, as we officially enter into this downturn in the economy, we hear about this word recession a lot. He's going to offer some advice. All right. So before we begin, John, why don't we start, briefly introduce yourself and Capcom Financial Service and what it is that you do for individuals.
Hey, Chris. It's nice to be here. I guess for those listeners who don't know, Capcom Financial Services is the wholly owned subsidiary of Capcom Federal Credit Union. Been kicking around since 1953. And we have a team of salaried advisors with more than 60 years of combined experience. And we work with a range of clients, from high net worth investors to those just starting out. And my official role is Chief Investment Officer to help guide our advisors and our clients to financial independence.
Okay, great. Now, John, I noticed you used a word in there that maybe was specific, maybe it wasn't on purpose, but you used the word salaried, and I typically don't hear that word thrown in there, right? You said salaried advisors. Did you say that deliberately? Is there a reason that you use that word?
Well, actually, not all advisory firms or advisors are paid salaries. Most financial advisors are paid a commission based on the investment products they sell. And we provide objective advice and focus on each individual's financial needs. So being salary professionals aligns perfectly with our concept of working with a team and a stewardship for our clients.
Oh, okay, I see. Well, so that's nice. So someone like myself or a customer out there or a member, I guess you can feel more sort of at ease,
Exactly.
I guess, knowing, right, that the information we're getting is based on actual info and not just you trying to sell as many products as you can for commission. Okay, that makes sense. That's
you
great.
Got it.
Okay, so thanks for explaining that. Let's now jump into the subject for today. I follow the news regularly. I'm sure a lot of people out there have been consuming a lot more news. But as far back now as August or the summer, I feel like I've been hearing people, analysts, pundits, throwing around the R word, the recession, right? Where we're heading towards a recession. Looks like there's signs of recession. And they're always making it sound like it was inevitable and it was, it's on its way. And now we're here. Now we're in the midst of this pandemic. And now it looks like the inevitable that everyone was talking about is actually happening. So is now the consensus in the field or in the financial world, we are now in a recession, an economic downturn recession?
Well, Chris, the easy answer is the economy is doing well just a few months ago. But today, most people believe we are in a recession.
Okay, so you said most people believe. So this is the thing that I find, as a scientist from a scientific background, I've always wondered, is there, recession, is it objective? Like, are there a bunch of boxes that you check off and then when all of those are checked, you can then make the conclusion that you're in a recession, or is it sort of subjective? How does that work?
Yeah, I'm absolutely the same way, Chris. Obviously, I'm a finance guy. I'm a numbers guy. Many people, what they do is they would define a recession in simplistic terms as 2 consecutive quarters of negative growth.
Okay.
The official dating committee, and yes, we do have an official dating committee, it's called the National Bureau of Economic Research. And it defines a recession as a significant decline in economic activity spread across the economy lasting more than a few months. And that's why everyone's saying we're going to a recession, because basically we shut down the economy in response to COVID-19.
I see. Okay, so there is some sort of objectivity to it. I imagine how people arrive at certain numbers might be a little subjective, but there is some sort of terminology that standardizes it a bit.
Yeah, the great example is the first quarter results. Our GDP at an annualized rate was a negative 4.8%. So there's 1 month, or 1 quarter, I should say.
I see. Okay. I've always wondered that. I just figured hey, can people just say recession, and then we're in one? But okay, so that helps to clarify that. It was 2008, which is about, a little more than 10 years ago, where we had the Great Recession, 2008. I was obviously in a different point in my life during that time, but experienced, some of the hardships, and other people experienced hardships in that time. And I know people have been wondering this, people talking, is this different, right? Are recessions different? Is this recession that we are in, is it different than the most recent one in 2008? Can you speak a little bit to that?
Well, Chris, if our listeners could see me, they would see every gray hair I earned. It was about 11 years ago. And I tell you what, the main two reasons this really feels different than the Great Recession. I mean, did have the word great in it, but COVID makes this one different because it's magnitude and speed. First, let's look at magnitude. It's a public health and safety concern, and that impacts all of us in a very, very personal way, right? Our family, friends, community. We probably know someone or heard of someone. It basically all of us. It's a global pandemic.
Yep.
I think the second thing, if you get beyond magnitude, which is enough to make it feel different, is really speed. Just think about how fast the virus spread.
Yeah, really.
Right? And then a 30% decline as the markets follow the Dow Jones Industrial Average from its peak in February 19th makes this the fastest move down from peak to bear in the history of the Dow.
Wow, that's true, huh? So that is historic? That hasn't happened before?
So magnitude and speed, that's it.
So what about uncertainty? The uncertainty here is interesting because no one really knows this virus at all and what's going to happen. So I imagine that doesn't help either to calm markets down as to know when this thing, towards we get to signs. Is it always uncertain in a recession, or does this feel a little different?
I think, Chris, the whole point of it and the reason it feels like a recession or a crisis is because of the uncertainty. So the nature of a crisis, that uncertainty creates all this turmoil. But, I've been doing this for over 35 years, and I could tell you what a crisis all have in common, or what makes them similar, is they have a beginning, a middle, and an end.
An end, huh?
We can't always predict duration, but there is an end.
Okay, well then let you bring me to the $1 million question, right? And we know that you're not a can't predict the future. You're not a crystal ball reader, but everyone wants to know, John, like, when will this thing end for me and my financial, struggles? So how do we provide, or how do you provide any insight, or what do you look to when you're trying to get a sense of where that end is?
Well, first of all, Chris, you promised you wouldn't tell our listeners that I didn't have a crystal ball, but yeah, it's true. You can't necessarily predict what's going to happen in a crisis. And that's what everyone's asking. So what we do is we just turn that a little bit, and we have our clients focus on the recovery. And then we're looking at 5 signs the recovery is on the way. Number 1, pay close attention to China and New York City. Those are the original epicenters. If we see cases slowing, there could be some light at the end of the tunnel.
So you're looking to them because, like you're saying, they were epicenters, they were hit very hard. China was a bit ago. So, you could see some signs coming out of that and how they're coming out. And that gives you a clue and a sense of what happens here.
Yes, you see little things like the population starting to migrate in China, or factories opening up. That's a sign. And you see New York City slowing with the cases. That's a sign that there's some light at the end of the tunnel.
Okay.
I think the second thing, once you go beyond the epicenters of the virus, is monetary policy. Will the Federal Reserve provide liquidity in order to the markets? And you can say yes here. The amount of stimulus that they've been providing, they've been doing an excellent job.
So I'm sorry, John, you're saying liquidity, meaning, are they injecting money or putting it back into the system to keep things going? Is that what you mean there?
Well, they have a lot of levers, and that's one thing they learned in the Great Recession. What I think the best way to frame it for our listeners is that in a crisis, people need to sell and buy things, whatever that is, whatever their holdings are, bonds, stocks. They need money to borrow to keep their businesses afloat. So the best way to put it is Federal Reserve keeps interest rates low and provides capital, so there's an orderly exchange in the marketplace. Okay. And they're doing a great job. I can't list all 10 to 12 things that they've done, but the key is they've provided liquidity and order to the markets.
Okay, cool.
I think once you go beyond, the epicenter, then you talk monetary policy, then you talk about fiscal policy. And that's where all the branches of our government need to work together and really focus on the gap that has been created by the virus and the shutdown. Individuals and businesses, if you can almost visualize a bridge, they need a bridge to the future. It's been interrupted. We need to get to the other side. And where we're back to work and doing little things like eating, even if it's at every other table. But those are things that would suggest the government has helped us bridge from where we are today to better days. And the first stimulus was passed back on March 26th. So that's a good sign.
Okay.
So you've got the virus tracking it, monetary policy, fiscal policy, and then number 4 is the media. I find that they do an excellent job of keeping us informed, and a lot of people are tuning into the media. And in the beginning of a crisis, the language response is very dramatic, very dramatic. But when the media is able to focus on positive stories, that becomes a positive sign. And number 5, when generally accepted benchmarks like the S&P 500, they start this bottoming process, the recovery may have started. And that usually leads the recovery. That responds before the actual economic recovery. Now, only time can predict the exact date, but we do know that historically when the market declines over 30%, and it has, we are closer to the bottom than the top. So that can lean towards, hey, maybe we're on our way.
So these 5 indicators that you just mentioned, and with every point, I think it seems like there are some signs that might be pointing in the right direction, right? But I mean, obviously, it doesn't mean that we're at the end or the end is right here, but it seems as though with these sort of 5 points that things are looking or pointing in a good direction.
They absolutely are. The only reminder I tell people is anytime you look at a chart in a recovery, remember there's peaks and valleys, there's up and down, but there will be volatility, but pointing in the right direction, yes.
Okay. So that's good. Pointing in the right direction is better than pointing in the wrong direction. So
yes.
So I know that this recession, this downturn affects people differently in different stages of their life, right? And I want to pivot a bit to retirement, and it's interesting, my parents are right at that age, John. My mom, she's a school teacher. She's retiring this year. This would have been her last year as a teacher. She didn't really want to go out like how she did. She didn't know that in spring she would be probably never going back to her school again. But she's right at retirement, and my dad is right behind her. So I've seen the stress from them and how this is going to affect their retirement savings that they work so hard to build up. And I'm sure this is a question you've been getting a lot, right? And it's very poignant on people's minds. So how do you answer those sort of questions when about retirement when they come to you in this crisis? So what am I going to do, and how is this going to affect me? Can you talk a little bit about that?
Oh, sure. Well, first, thank your mom for all her service. Teaching is a noble profession, and
I will do that.
Interesting time to retire when it's kind of just happens, and you don't get to interact at the same level you like to.
I know.
Wow. But hey, that's just a classic example where life goes on. What Capcom Financial Services tries to focus on, and we have our clients looking for that eventual declaration of financial independence, what people call retirement. We say, take control, you try to dictate, pick your financial independence date, we'll help you get there.
Okay.
And what happens is, like your mom and other people with life going on, they fall into 3 general stages in life. You're either saving for retirement, you're close, I don't know if you can get much closer than your mom, and then you're living in retirement. They're all affected by what's happening in the markets.
Right, and obviously it's different in each stage, I imagine, right? So let's talk a little bit about some of those stages. Let's come back to where my mom is now. Let's work our way up the spectrum. So, people who have a longer time, right? So someone like myself, or someone a little bit younger, right around that age, who's got working, maybe they're contributing to some sort of retirement savings, but they're not retiring anytime soon. Should they be thinking about something? What do you advise people in that stage?
Well, of course, due to my profession, I always want them thinking about financial independence and retirement. But we have jobs, we do things, and you go on to other things. So for people that are greater than 10 years or more from retirement, they should be thinking about financial fundamentals and really about their long-term goals. Now, that's true during good and bad times. and it's an important key towards that financial independence. When we check, really, Chris, on our clients' and members' financial fundamentals, we review a lot of things. But at this time, let's kind of focus on what I think two of the most important things are, whether it's a crisis or not a crisis, and that's debt level and savings. And if we kind of start with debt, I think it's obvious because the sooner we can pay it down or off, the more financially sound we will be.
Well, John, I mean, I can speak for myself and people of my age and younger, maybe probably even like a little bit older, is that there's people, we're carrying a lot of debt, right? There's credit card debt, student loans, get crazy, So I don't know, is there anything now or that's going on that might be able to help with that? Because that would be important.
Yeah, a couple things. One is we talked earlier and you asked the question about what's the Federal Reserve doing and how are they helping? Well, they're lowering interest rates to help stabilize the economic condition. And they cut their target rate to a record low between 0 and 0.25 or 25 basis points. And that was been there for a little bit. So if you compare that to 2.5% over a year ago, those rates are lower. So what that typically means is potential loan rates could decrease. So it may be a good time to look at consolidating debt into a lower interest rate loan, like a home equity loan or a low rate personal loan, maybe even refinancing an auto loan. They can be good ways to kind of looking at that to ultimate decreasing the cost of the debt. And it may lower your monthly payments.
People in this time are, especially if they're having a decrease in money in, so if they're not making as much money, you have to look at what you're putting out and see how you can cut your costs back, right? And so I think typically I do, and I imagine other people think, well, I have to get rid of payments, right? What can I get rid of? What can I eliminate? But this approach is not necessarily eliminating, although I would love to, my car loan, but it is refinancing it to a lower interest rate that essentially would lower my monthly payment. So I'm not getting rid of something, but I'm just paying less because now there's a better interest rate for me. Is that right?
That's absolutely right. And you're paying less, which helps cash flow.
Okay, correct.
The other thing, too, is just very specifically on the student loan payments, you are able to delay those until September 20th. So with the heavy burden that we face, especially with getting an education nowadays, that's good to know. Now, I will say the caveat here is there's good reason you might want to still make timely payments on your loan, even if you're temporarily not required to, just to keep on top of it. But for people, we should mention it, if you've had a change in income due to the current crisis, this could be a relief.
Right. So I see what you're saying. So, but the option is there for you. If you need really that cash flow, you can see how you can get a forbearance. Okay.
You got it, Chris. We can't dictate that. We don't know that. So
okay.
In general, you want to keep current on your debt to reduce the amount of interest you pay, but there are times where you want to make adjustments.
Okay, so that's debt. So we talked, maybe take advantage of the low interest rates. And if you have student loans, you can, if you want, see what you can have, held or not make payments. So those are all good ways. What about savings, John? We talked about savings.
Yeah, I think, Chris, one of the big things is you want to make sure you have some kind of savings or some kind of emergency fund. I think we know that most Americans really don't. A new survey from bankrate.com found that 20% of Americans don't save any of their annual income at all. And even those who do save really aren't putting away a lot.
What they'll say, John, sounds easy, right? But in a time like this where money is tight, I'm sure you get that from people. Well, easier said than done, right, John? Like, how do I start saving? So what can you offer to that line?
Yes, brilliant, John. In the middle of an emergency, set up an emergency fund. I wish I thought of that, but
exactly.
I think you're right. And there's always a reason not to start saving money. But what we have found is that there's usually money that can be found if people build a budget. And everyone has time now, and you can build a budget. It can sometimes really be surprising where all the money is going. Now, you may order a lot of takeout now is required, but before that, maybe too much. Maybe some subscriptions that you don't use, or that coffee from the really nice coffee shop. Mm-hmm. So maybe some of those things you can evaluate and create a budget. And then once you establish the emergency fund, which is key, that's your base, you can think about how much you can contribute to a retirement fund.
Okay.
And there's one concept, Chris, when you think beyond emergency fund, then saving for retirement, that our listeners will want to remember, and that's what they call dollar cost averaging. And that's when you're contributing a set amount of your retirement into your retirement account consistently over the long term can actually help you decrease the average cost you pay per share. So, like now, in the case of a market downturn, the position you buy in an investment account may be less expensive to purchase than you would be during in the up market where their value is greater.
I see.
Right?
Okay.
So
that makes sense.
So that whole concept that we're talking about, doing a budget, trying to put some savings and saving for the future, and then leveraging or using dollar cost averaging, it requires a continuing investment, regardless of the fluctuation in price levels of the investments. An investor should consider their ability to continue purchasing those through the fluctuating price levels. And as a reminder, dollar cost averaging or such a plan really does not assure a profit and does not protect against loss in declining markets, but it's a consistent way to buy when it's low and buy fewer when it's high.
This would be something that we're talking about, 10 or more years out, right? And now it's getting tough, it's getting tight, and I'm looking at my paycheck and I'm getting a certain percent taken out going into a retirement fund, whether it's a, 401k or something like that. And my initial reaction, I'm speaking just first person as an example.
Sure.
My initial reaction would be, John, you know what? I'm going to stop the contribution right now.
That's real.
Because I can get that. It's a couple $100. It means a lot. I'm going to cut it. So before I go ahead and do that, would you advise me to, again, take a look at the whole budget before that? I mean, I know people have their own situations and that might be necessary, but we shouldn't knee-jerk just to stop putting into a retirement fund.
That's correct. And yeah, everyone's situation is different, but doesn't mean we all can't go through that checklist.
Okay.
How's my debt? Can I refinance it? How's my budget look? Can I squeeze a little bit in my emergency fund? And can I maintain my long-term savings? We should all do that.
And if someone doesn't know how they can do all this, that is where you and Capcom Financial Services can help, right? Make sense of how we can do things like this, because I don't really know. Right. Okay. Yeah. So that's great, because I'm serious. There's a lot of these things that are out there that are available that we just really don't understand. And that's why I think today's conversation is really relevant and important. So
yeah, a great way to think of it is when I wake up, I go to work and I'm doing this. Talking about financial
business. Exactly.
When you go to work, you're doing something totally different.
Exactly.
So leaning on another professional is always a good idea.
Okay, so we did 10 or more years out, right? So there's some good tips there. It makes sense. Now, what about the people who are more like in my mom and dad situation, or maybe even 10 years removed from retiring, or they're living in retirement? That's a whole different conversation, I have to imagine. So let's talk a little bit about that.
Oh, it's certainly different. And it's another, commonality between this current COVID crisis and the Great Recession is that, or other crises, are people are going to continue to live. They're going to continue to retire while it's going on, just like your mom. And certainly there's millions of people that are already retired. So the first thing a lot of people say about this is, well, should I even retire? Should I wait?
Right.
And that, that may work, Chris, for some people, but others may not have a choice. And that's what we remind people. About a third of people don't pick their retirement date. It picks them, whether it is due to their health, an employee buyout, or something else. So let's be prepared. Let's take control of that.
Right. I've heard, John, stories of right now, like teachers in particular and people working in like some factories are getting pretty close and they thought they had a couple years left. They're reassessing and saying, should I retire? Should I retire now?
Right.
Like, do I have the ability to, and such? Like you're saying, it picks it for them. I imagine you've had those discussions.
Yes. And it's interesting, Chris. We've had other people that responded the opposite. Like, I've had enough. I'm out. Like, I'm going to retire. So people are still making decisions, whether that's deferring or they don't have choices. So our whole job at Capcom Financial Services is to help people control as much of that as they possibly can.
Okay. All right. Now, what about what about some clients that they're already retired, right? But getting nervous. These markets are down, and they want to take their investments, they want to move them to cash and sort of ride this out. They're nervous, so there's emotion involved. What do you say when you hear things like that?
Well, first of all, I say that's an absolutely natural reaction.
Yep.
Right? It's natural, but that's really our emotion talking.
Yep.
That kind of move would lock in all of your losses to that point. And you may also risk missing the market recovery when it comes. Think about how down the market was in February and March, and then what happened in April. So we tell people, don't hit the panic button. Our job when we talk to clients is really to help people manage these kind of big decisions. And they're hard ones to make. This is real money. These are people's, right? It's people.
This isn't Monopoly.
No,
this is real.
Dang, go straight to jail.
We're not going to pass go.
Yeah, you didn't land on
right?
Boardwalk with 2 hotels. It's like, oh my God. These are people's real lives. We're not a toy car. And that's why we use really kind of a serious and a disciplined approach. And we focus on asset allocation and investment strategy, really to help people set and reach their goals. And I say goals because people get lost on ups and downs of markets and investments, but you got to keep your eye on the goal and stay on that path you need to follow. And to be honest with you, Chris, ultimately, it's why we have a full team of professionals at our clients' disposal to assure stewardship of their investments and to help them work toward financial independence. And I'm going to say that again. Ultimately, it's why we have a full team of professionals at our clients' disposal to assure stewardship of their investments and to help them work towards financial independence.
It's like a financial psychologist. You're there, you're managing my emotion as well as obviously offering a professional expertise, but there's a whole bit of emotion in there as well. Especially when it's right around that time, like my parents, like, oh, what am I going to do? I got to do something, right? So that it's helpful to talk to somebody in that time so that they can tell you, listen, I've seen it before, right? We're going to get through, and that sort of little bit, take a deep breath and then continue the path. So that's great. I know my parents have went through that and are I think they're on the other side of, they had that freak out, right? And then they had conversations with some financial advisors and they're feeling a little bit better. So that just speaks to that. We're in the midst still of this COVID crisis, and I'm just curious, like, what are some of the things you're advising your clients to do during this whole thing,
Yeah, thanks, Chris. I mean, everyone's in a different spot, and there's always things I thought today that we want to review with our investment clients near or living in retirement. They're important regardless of market conditions, but at a time like the COVID crisis, the points are definitely worth going over. The first tip is to evaluate your time horizon and risk tolerance, and then compare that to your asset allocation. In other words, decide how long before you need the money, and if you've invested, and how much risk are you comfortable taking with it. If you're retiring in 3 years or so, and you're not touching the investments until then, that's your time horizon. And if you're not comfortable with the idea of potentially losing any of that invested money, you likely have a conservative or low risk tolerance.
Okay.
So once you know those two things, Chris, time and risk, check that with your asset allocation and make sure it matches up. For instance, if you have a low risk tolerance and your allocation is reading high, this is an obvious mismatch. Right? Okay. And crises have a way of pointing that out to you. So review it with your financial advisor.
Okay.
The second tip is that if you have a few more years to work, increase your contributions to your retirement plan. And just so all of our listeners know, I always throw that in all the time, because that's one way we can improve our chances of achieving financial independence when we want, increase our savings. I think what I will remind people is that in down markets, they are buying opportunities because the lower cost of the shares. And then when you can benefit from the uptick in the market if that comes. So continuing making contributions, you have a better chance of participating in any market rebounds that may occur.
Hey, John, how does one know what their risk tolerance is? Like, is there a test that you could give me or do you just have a conversation with me, or is it just the customer just says, I don't like a lot of risk? Like, that seems a little subjective. How does that work?
No, there's definitely an interview and a quiz and a checklist to determine that. So you go through that kind of questionnaire to determine what risk level that you, and I say this, think you are. And that's why I said the crisis is a good way to test that. Because there's one thing when you measure it through objective questions, there's another when you actually live through it. Oh,
right.
That's what 10%, that's $100,000.
Right. You start to really see the stuff.
Yeah,
right.
exactly.
That makes sense.
So that's a good test.
So you're talking about looking at the numbers in your portfolio. Like, I mean, at this point, it seems like a time where you would consider maybe switching up the portfolio or changing that up. Is that something that you advise or you look into with the client?
Yeah, so there's two other action items that you can take that are a little less obvious and seem counterintuitive, but one would be rebalance your portfolio when it's volatile. So rebalancing involves selling some of your winners and buying some of your losers to kind of get your portfolio back to a neutral allocation to help you kind of align with your investment objective. And rebalancing a portfolio, you can incur some potential tax liabilities or transaction costs, and it doesn't necessarily assure a profit or protect against loss. But that's why we systematically rebalance many of our portfolios we have with our clients for that exact reason. And we do it on a regular basis.
That makes sense. Okay, cool.
And I think beyond rebalancing, the fourth tip, the action item, is it may be a good time to consider converting to a traditional IRA to a Roth IRA. And why would people do that, Chris, is because Roth IRAs allow qualified contributions to grow and be distributed tax-free. So if you convert when stocks are down and if stocks rebound, future gains would be tax advantage. Traditional IRA accounts owners should consider the fact that there are tax ramifications, how old are you, and there's potential income restrictions regarding executing conversion from a traditional IRA to a Roth, because the converted amount is generally subject to income tax, but definitely worth looking at.
Okay, and that's obviously something that you and your team would help us assess. Like, we wouldn't have to know all of those things,
you wouldn't.
Right?
All you'd have to remember is, hey, should I convert my traditional IRA to a Roth? And then we can help with the rest.
All right. So thank you. Those are great, tangible tips, and that's exactly what we're trying to get to today. I don't know if this is a dumb question, John, but I know, I hear a lot. It's not. You got to start saving for retirement early. Earlier the better. Early. But the question is it ever too late? No. To someone like especially in a time like this, is it ever too late to plan for it? In other words, you get to a time point, you're 55, and you're like, it's too late. Sorry, can't help you out.
No, not at all. Matter of fact, a lot of the stuff we talked about is just as important if you're greater than 10 years or about to retire. Savings level, reducing debt, budget, those are all things you can make sure you do. So not a dumb question. And we try to really help clients kind of wherever they are in their journey. So in this particular case, when we're talking about people closer, whether you're retired or kind of living in retirement, you should consider creating a retirement income plan. So we use these plans to help really our clients understand what I was just talking about, their potential expense down the road. Things like healthcare cost, housing, taxes, but also costs associated with their lifestyles that could change, like traveling. Maybe you do more traveling. And then you evaluate their current investment strategies and financial situations, kind of relative to what those costs might be. So in other words, are you tracking for the retirement you want and the time you want to retire? Or if you are retired, can we make tweaks to help you afford a certain lifestyle without kind of running out of money?
So in other words, I want to have a villa in Tuscany with a convertible, and with a vineyard there, and I would come to you and you would help me figure out what would be the plan that would look like that could get me there. That's it, right?
I'll say two things to that. One is it's possible. I literally got a picture from a client. He took a travel to Italy, and it was him and his wife sipping wine on a hill in Tuscany.
There you go.
It was
there you go.
I said, thank you very much. There is hope for us.
There you go. That's great. That's great.
So yeah, it'll an income plan will help you achieve that. and really define it.
Okay.
And to be honest with you, Chris, answering those types of questions, in our opinion, is the key to achieving and maintaining your financial independence. And for us here at Capcom Financial Services, there's nothing better really than helping people to do that, whether the market is up or if the bear is roaring like it is now.
All right, John, I mean, I'm looking at the time and I think it's about, the time to wrap up, but I got to say, I really appreciate this dialogue and these tips, and just having this conversation for me illuminated some things. It helps me see there might be some things I should be considering, that I might, talk to people that I know and ask them if they're considering. So I know that I have information here that listeners, if they want to know more information or they want to talk to someone like yourself or your team, they can contact Capcom Financial Services. They can go to capcomfinancial.com or they can call 518-782-0209. That's 518-782-0209. And they're doing virtual appointments, right, in the age that we're living in today. And I imagine that once you guys go back in to the office, you can meet with clients at headquarters right off Wolf Road in Albany. John, I really appreciate it. Thanks for illuminating, some of these things. I know it's hard to talk about some of this stuff. It's tricky, and it's a little bit complicated, but you really boiled it down for us. I appreciate it.
It was absolutely my pleasure, Chris. And, I really enjoy working at Capcom Financial and Capcom to, help our clients and members succeed. And I enjoyed the dialogue just as much as you did. So thank you very much, Chris.
Great. Thank you.